Yes, guys, welcome to the next lesson. So in this one, we're going to be looking at reduction of asset purchases. So moving on from what we looked at last time with quantitative easing, you've got to understand that the economy can't keep up with their QE program, especially when there's times of higher inflation due to the QE program and all the money supply in the economy. You've got to understand that eventually the Fed and the other central banks in other countries, they have to dial back on all these asset purchases. So let's take a look at the US QE program at the moment. So particularly since the peak of the pandemic, the Fed has stepped up its QE program to $40 billion a month in treasury bonds and then $40 billion a month in mortgage-backed securities. And like we mentioned before, these are the two main asset classes that they look at. Of course, there's other types of assets too, but these are the main two. So what happens if this continues? We're obviously going to be seeing out of control inflation that can lead to an overheated economy, which severely leads to the depreciation of the domestic currency. As a result, the Fed have obviously got to act upon this and take action. So a reduction of asset purchases must start to take place. You simply can't keep increasing money supply without expecting something negative to happen. So in terms of reduction of asset purchases, the term that especially the Fed uses the word tapering. So that's simply just the reduction of expansionary monetary policies as seen as quantitative easing. Now, how can tapering occur? There's two ways. First way is to reduce asset purchases per month, which is what we're potentially going to be seeing from an announcement from the Fed soon. And then hopefully that will come into place by 2022. The second way is to allow the assets to mature. So as you understand, especially when it comes to the bond market, every single bond purchase has an expiration date. So you have to look at the maturity of that bond asset. So they range from 3 months all the way to 30 years. And of course, it depends on which types of bonds the Fed decides to purchase. And I believe they released this information. But yeah, guys, these are the two main ways that tapering can occur. Now, what are the confirmations of a tapering announcement actually happening? So first of all, the Fed, they do want to see an improved employment number. And that's the main thing when it comes to, increased money supply. With all the increased money supply and all that inflation that's coming in, of course, they want to see higher GDP. And of course, that leads to higher employment rate. The second thing is the CPI number. So we've briefly went through this in the first stage of the fundamental course. So as soon as they start to see consumer price index numbers increasing and of course showing higher inflationary numbers, that's when the Fed starts to realize, okay, enough of our quantitative easing program. We're starting to see, an improved employment number. And of course, inflation is increasing right now. I believe for the moment, they've just released information that year on year, inflation was recorded at 4%. So of course, what economies usually aim for is just 2%, and now the 4% increase, it's quite a hike from that. But of course, we've had the pandemic and everything around the world with global macro. Now, tapering is only expected when the overall economy is showing substantial progress, as we've just gone through. Now, the problem with actually announcing tapering and the reduction of assets is something called a taper tantrum. Now, the reason why central banks don't immediately announce a shift in policy is because a taper tantrum can occur. This means an announcement will be made of slowing down quantitative easing pretty much immediately. The reaction in the markets can actually be seen in the US Treasury yields. Example of this is the US 10 yield chart. If you look back in the 2013 taper tantrum, and this is the first time it was really heard of, so this term taper tantrum, have a look back at the quantitative easing program from the 2008 crisis and how that continued on, because eventually the Fed, they didn't really announce anything about the reduction of assets until about 2012 and 2013. Now, the issue with this is when an announcement is made, and you're going to see immediate shifts in the markets, especially with the US Treasury yield markets. Now, if you have a look back on that chart, you're going to see a massive crumble after this announcement due to the panic. Now, this is going to be for a short while, so you might see a range in market, and that's what I'm expecting in the beginning. But as soon as you start to see interest rate hikes, which usually happen after the reduction of asset purchases, that's when you actually start to see DXY, appreciate in value rather than what we're seeing at the moment. So this just proves the point that the market becomes way too reliant, especially in a time like this, on the influx of money provided by the Fed. So of course, as you understand, with all these asset purchases that are happening, money supply increases, particularly M2 supply. And you realize that especially consumers, they start to see benefits in the market. They get benefits every month. And as soon as you start to hear that, okay, you're not going to have as much money supply in the market, you start to see, massive shifts in the treasury yield market, especially. Now, anyways, guys, keep researching more about this, particularly what we saw in the 2013 a taper tantrum, and then of course earlier before that in 2008, 2009, everything that happened after there. Read about the quantitative easing program that happened back then, and understand one thing: that QE program never even successfully stopped. I don't think there's ever been a 100% efficient stopping of a QE program, because central banks, they always want money supply to increase, because they kind of need it to stimulate the economy. If they completely stop, we'll get a completely stale market and very deflationary conditions. Anyways, guys, I hope you understood. Please take notes of whatever I'm saying, and obviously look back on the previous lessons. And another source, I'd say, I'm going to add some links at the end, but Investopedia is an amazing place. Obviously, search this up on YouTube as well, just to get a better understanding. Anyways, guys, take care, and I'll see you in the next video.